Hey everyone, so we'll get started now. The attendee count will keep increasing as we move forward. But so very quickly, firstly, good evening everyone, whoever is based in India. Good morning to folks in the US, and good evening to folks in Asia. So my name is Madhur Singhal. I'm a managing partner and CEO at Praxis Global Alliance. I do a lot of work in internet and tech. Have been working on SaaS, which is the topic for today in particular, over the last 8 years. Have personally led more than 25 commercial due diligences on different SaaS businesses globally. And so today, what we're going to do, we are a part of Praxis, which is a global firm. We've worked across the globe, 50 countries. Across 6 continents. We do a lot of research work across the globe, and we do a fair bit of diligence, commercial diligence work, technical diligence work across the globe. So today, this particular masterclass has been brought to you by sort of 2 practices to partner together. One is Financial Investors Group, which is where we work with a number of investors, and the high-tech IT and tech practice, which is where we do a lot of our work around software, SaaS, IT services, and so on. So very quickly, just introducing our practice before we get to the agenda. So, on the high-tech side, we work with several industry practitioners, folks like Vipul, who's a practice leader with us on ITES. We do a lot of IT diligences and BPO diligences through. With Vipul, with Shekhar, who does a lot of work around BPO, and then there are a number of players, a number of folks in our SaaS team who look at horizontal SaaS and vertical SaaS separately. So the focus for today, right? So we're going to do 3 things. We're going to discuss cloud and SaaS basics. Some of this probably will be very basic. We'll not go too technical. But this is to level set the audience on what cloud is, what SaaS is, and maybe if there are sort of misconceptions around what public cloud means. Is public cloud really public, right? We can talk about some of that. Second is we'll discuss the SaaS concepts and specifically talk about what do you look for in a SaaS company? How do you spot the winners? What do the winners do well? What are some of the pitfalls in a typical SaaS company? Lastly, we'll reflect on a diligence framework for SaaS. We show you some examples, real examples of SaaS diligences we have done. Of course, some of the SaaS work and the market assessment examples you will see in the first section and the second section as well. But the third one, we'll particularly sort of try to create a framework on how to diligence a SaaS business and how to then sort of evaluate the value creation potential. So overall, this quick guidelines to be followed. Now, given this is a masterclass, so I'll probably end up doing most of the talking. But if there is a very pressing question, please do raise your hand. I'll try to take those questions. Put the questions in the chat box. I'll try to answer them as we're going. We can at the end of the session, I think we will try to leave some time so that we can discuss specific points. But if there are unaddressed questions, we will try to get back to you, and we'll be very open, of course, as an organization to set up separate sessions if certain things are of interest here. Also, we'll be sharing the key takeaways of this session with all the participants. You might not get all the slides, but most of the slides you will get. Also, the session is being recorded, so I'll encourage you to urge you to not spill the beans on your investment strategies, investment plans, etc. Given that the recording will be circulated in a closed audience, but it will still be public. So if there are specific conversations you want to have on portfolio companies, on deal pipelines, etc., happy to tailor a separate session with our software and SaaS teams. So with that, let's actually very quickly level setting on the overall B2B landscape in India. Overall, India is, of course, a sort of a very fledgling, very bustling startup ecosystem. A lot of money getting poured into Indian startups, and in particular, also in B2B. So if you look at the B2B world, we look at, of course, marketplaces, which though most of them exhibit SaaS-like characteristics, we have not paid attention to them in this masterclass. Then there are listing platforms which also exhibit a lot of SaaS-like characteristics, but again, we have not looked at them in detail, for this masterclass. Today's masterclass is really focused on the fifth vertical here, which is, truly sort of software as a service, and we'll stay focused on software as a service, even though some of the fundamentals and concepts we discussed today will apply in a large part to listing platforms. And and there are several sort of AI companies, customer experience companies, connectivity providers, where similar concepts, payments companies, where similar concepts apply. Why are we talking about SaaS? I think when we look at, all of us know that the B2C landscape in India is, of course, fairly evolved now. But on the B2B side, bulk of the money that has come, VC money that has come into India, has actually come in SaaS, right? So there's a lot of MSME focused SaaS. There is a lot of enterprise grade SaaS, and then there is AI/ML, which is ultimately delivered as a service, even though it is not necessarily a software. And then everything else that you look at, marketing tech, skilling, robotics, co-working, marketplaces, B2B marketplaces, they still have a much smaller part of the investment pie that is flowed into India. So the deal flow, and one of the reasons why we are so excited about SaaS is that the deal flow in SaaS will stay quite robust, and this is just a sample. We actually have a much longer list, in our PGA Labs Deals Pulse database. But, what we put out here is simply companies that have raised less than $2 million of capital in the last 2 to 3 years. And you will see that this list is around 153 companies, and I don't, claim this to be a comprehensive list. I'm sure there are businesses that we have missed while making a list like that. Again, you don't need to go through the details of the businesses, but just wanting to sort of level set that that the deal flow in SaaS is very robust and will continue to be very, very solid over the next decade, if not more. Now let's jump to the cloud and SaaS basics. Right? Now, firstly, look, B2B is very different than B2C, right? And a lot of investors we speak with, right from Series B to very late stage investors, it needs a very substantial change of the hat when you're looking at B2B deals, right? And B2B, even if it's SaaS and even if it's internet driven, the sales in a B2B setup tend to be much more relationship driven, unlike in B2C where it tends to be a lot more product. Also, the buying decisions are typically very rational versus in B2C where the buying decisions can be emotive. There is a lot of rationality in B2B purchases, which also applies to SaaS, coincidentally. Also, in B2B, typically the customer is trying to maximize the value of the relationship. In B2C, and even the supplier is trying to maximize the value of the relationship because of the stickiness. In B2C, while of course the concepts of LTV and CAC are pretty strong, at the end of the day, every transaction is sort of independent of the next transaction in B2C, more or less, while in B2B, the stickiness is much stronger. B2B markets, and we talk about this in this section about how SaaS is not just one market. In fact, even CRM is not one market. HRM is not one market. There are actually many, many different markets. And so it is very, very important to understand what is the target market that you're investing behind, when you're looking at a certain company X. And that also tells us why the deal flow is so robust in SaaS, unlike in B2C, where you very quickly land on winner-takes-all environments. Also, it's a multi-step buying process, longer sales cycle typically. Brand identity typically created through personal relationships. We'll talk about certain types of SaaS businesses which exhibit B2C type characteristics when it comes to brand, but those are far and few. And we'll talk about, we give you a framework around how to think about that. Also, B2B, is not as much about ATL. On the contrary, you need to do a lot of sort of customer level educational activities, demos, building awareness on the product. And typically you're dealing with a set of multiple buyers in any enterprise or even an SMB, unlike in B2C where you need to appeal to an individual buyer. Now, if you talk about software, right, and we not talk about personal software here, even though there is actually software and SaaS, which is personal productivity focused. For example, Evernote, or there might be other sort of productivity tools that all of us are used to using now. We will focus on SaaS and largely assume a B2B environment. Now, software buying overall, I think, has gone to the cloud, connected cloud, which is called public cloud. Now, public cloud is not necessarily public; it's just that it's hosted on an environment where you cannot disconnect the cord to the server, which is the reason why it's called a public cloud. So, most of the infrastructure has now moved out of a data center. It's the cloud service providers who actually use that same data center. The buyer, while the actual customer is an enterprise, today the SaaS solution needs to appeal to the end user. So that's why all SaaS sales or all software sales have actually are very complex, because they are B2B in their purchase, but B2B2C in their influence. Also, the pricing, 20 years back, 30 years back, you typically have a decision on how much spend to make on a certain server or certain software, but that has now evolved to saying, can I have a customer adopt a certain software, and I can pay them later as the usage grows. And overall, when it comes to distribution, it used to be very sales led, then it became marketing led, but now product led growth. But also we'll talk about the complexity of sort of when channel partners are needed versus not. Now, what is SaaS, right? And what is cloud? So we typically take this sort of very easy pizza example, right? If you were baking a pizza at your home, that is basically made in your house, made in your kitchen. Kitchen is yours, gas is yours, oven is yours, the dough, toppings, and the cooking process by itself is entirely yours, right? That is what the traditional software model used to be. You take a software and deploy it on your premises, and you manage the premises, you manage the software. Now, infrastructure as a service is where the infrastructure is managed by the vendor. So it's not your kitchen. You go to some other kitchen, but you take your ingredients, right? So you are the one who is in some ways sort of deploying an application. You are the one who's paying the bills, for infrastructure as a service. But everything else is yours. Security is yours, application is yours, and so on. And then if you take it one step further, and you say, I'll allow you to sort of choose the toppings so that you define the flavor, but the pizza dough is a constant, and I will give you the pizza dough that's a part of the, I can add it on top of the pizza offering. As long as the dough is fresh, you can sort of customize the taste. Now, that is a typical sort of walk in and bake, in a pizza setting. And then if you were to sort of literally order a pizza, a slice, a full pizza, family size pizza, you can customize the toppings. That's essentially what sort of roughly software as a service is. Now, all cloud is not SaaS, right? So one of the things that I have seen several investors get confused about is that they use the words cloud and SaaS interchangeably. Interestingly, only the right one. Now, this is a slightly technical slide, will not go into too much detail, but only the right-hand side is actually SaaS, right? Where a certain software application is being provided, as a service. But there are many other forms of cloud. There are many other applications or services on the cloud. You have data as a service, where you're getting data, where you're getting managed data centers. On top of that, you load your applications and so on. If you go further left, there is IaaS, which is where you just see you getting the infrastructure and the operating system. So it's almost like a virtual machine. Then there is IaaS hypervisors, which is what VMware gives, which is what also Amazon Web Services gives, which is where you're getting a machine on rent, but it's virtual, it's on the cloud. You're accessing the machine on the internet. but the operating system, you choose what operating system, what environment you want to work in, what OS config, what middleware, what applications, and so on. And then you have sort of IaaS also has just a more thinned down version where you get the infrastructure and the network, but you choose what servers, you choose the kind of virtualization that you want to create, which is what IBM Software's private cloud is. And then there is private cloud, which is essentially an on-premise or a owned data center deployment. It could be a third-party data center, but the server rack is yours, and you allow users, suppliers, customers. The difference, what makes the private cloud private is the fact that you can turn off access whenever you want, right? You can physically disconnect the server from external access, while on everything from IaaS to BPaaS or SaaS, you cannot physically disconnect the cord. Now, SaaS is complex, right? So SaaS is basically everything in an application as a service, right? So this is an example of a typical property management software where a hotel has a core PMS module. They have to optimize revenue, they manage guest experience, there is a front desk, they do housekeeping, but then there are modules, they're connected with third party, they're connected with channel managers and online travel agents for third party bookings. They also have their own digital interfaces, website, mobile phones, social media, etc. They might have some other modules, they might have other interfaces, HR, their own finance, and so on. So, it's important to understand that SaaS has several applications. Any SaaS product can be tiered. It could just be a core PMS, it could be a little bit more, it could be all of it. So most SaaS products are actually fairly complex, and most SaaS products are generally not complete in terms of being able to fully address a particular customer's needs. I'll skip a few, I think, but one of the things that's important to understand in a SaaS delivery model is, versus software as a product. The delivery here is hosted. You don't install a software. Development is actually, you see a lot of upgrades, much like how you see on app stores, on your mobile phones. The pricing is typically subscription. Now, pricing is a complex subject in SaaS. You could do usage-based pricing, you could do consumption-based, you could do metered billing, you'll do annual, right? So there is a lot of complexity in pricing, but in some form or fashion, it is subscription-based. It is typically an expense. You don't need to allocate a lot of capital. There is some additional cost and configuration versus earlier you used to install, maintain, customize, upgrade a particular software. It typically single platform, typically shorter frequent updates. The sales focus earlier used to be close the deal and then the customer gets wedded. Here you need to prove the value in the first 90 days. Acquiring a customer, not that difficult, but retaining the customer for the first 90 days or during the free trial or a demo period actually makes a ton of the difference. And then in terms of feedback cycles, very short. You understand, you can track, you can monitor performance, you can track usage, you can track adoption. And so as a SaaS provider, you get feedback very quickly. Your profits typically are ongoing. We talk about this in section 3 very quickly. And overall, the success in software sales used to be selling new licenses. Success in SaaS is lack of churn, right? If you can prevent churn, then you do better. Now, SaaS overall, why has SaaS caught on so much is that what we've shown here on the chart, on the left-hand side, we've shown red line is the costs. And so typically on-premise deployments, you would typically a very high cost upfront and then a very low maintenance cost. Orange line is the benefits, and yellow line is the subtraction between sort of benefits minus costs. And you see that in a typical on-premise deployments, the customer would start to realize value or will get to be in the money anywhere between 20 to 24 months. Now, the time to value in SaaS is very shortened, right? So customers can actually deploy a solution. A lot of times, SaaS providers will actually offer free trials, free users, doubled up users, six substantial discounts for first 6 months, 1 year, and so the market is truly expanded, not just in terms of number of customers who can afford an application, but also the number of applications that you can deploy, without having a substantial risk or a substantial capital outlay. And so in a typical on-premise software, you start with a very high cost upfront and then go down. And sometimes, a provider every 3 years or 4 years, much like with Windows, would ask you for a major upgrade, which will again push the cost up. While in SaaS, your cost sort of stays constant on a per user basis. Now, one more message to register, especially in context of India, is that market for SaaS is global, right? So most of the spend on public cloud services, India is actually a minuscule part of consumption globally. And bulk of the market actually is in the US. You see a fair bit in China, UK, Germany, some of the other developed markets. But India per se is not a very large market when it comes to overall SaaS spending. SaaS apps, and we spoke about why enterprises are adopting SaaS. The SaaS apps are becoming very pervasive. A lot of workloads are shifting to SaaS. What we've shown here is, x-axis is the company size by number of employees, and y-axis is the typical number of SaaS apps that are being used by companies of this size. You'll be surprised to know, but any business which is more than 5,000 employees typically runs around 800 applications. And of these 800 to 900 applications, 50 to 60% in developed markets have actually already moved to SaaS. So, the number of SaaS applications and SaaS service providers is so proliferated because of the underlying proliferation that you see in types of businesses and in types of apps. Now, one of the things that while I spoke about SaaS being adopted very easily, remember that SaaS purchase process is still not simple, right? While it's the capital outlay in SaaS is lesser than what you see in typical SDLC or on-premise software deployments, there is still a fair bit of cost. There is a lot of cost in planning. People or enterprises do not just deploy SaaS solutions just like that. There are substantial costs on implementation. Now they are lesser than what they used to be in the traditional software world, but you still have a fair bit of configuration, sign-on securities, subscription activities, data integrations, right? And then there are recurring costs in terms of training, in terms of subscription contact management, in terms of some change management on users. If you have a contact center solution, there will, changing a SaaS solution is not that easy also, even though economically it's easy, but there are a lot of other considerations that create substantial costs, switching costs in a SaaS construct. I will actually skip a few pages and talk about, sort of get into the meat of this discussion. See, how do you look at software as a service, right? And we look at it in 4 ways. One is solutions. So, you could have human resource related SaaS, ops related SaaS, sales and supply chain, and so on, pretty self-explanatory. Second is end users. So large enterprises, small and medium businesses, retail, which we typically say B2R, business to retail, or B2 MSME, which is business to MSME. There is actually individual SaaS also, like Evernote and some of the other applications, but we're not looking at it in this masterclass. Then you have types of SaaS. There are horizontal solutions which have cross-vertical application, and there are some vertical specific solutions, for example, in travel, in financial services, in healthcare. And then you have specific verticals that a particular SaaS product appeals to. Now we'll talk about why this is so important. Now this is an interesting page. The way we, one of the things we sort of in our software and high tech practice debate on is how do you show, how do you sort of represent this multi-dimensional framework of software as a service, across the globe. And so this is probably the best attempt that we could make. What you see in rows is the use cases that were also mentioned on the previous page. What you see in columns are the verticals wherever there is vertical SaaS. But then there is a massive, right, almost half of this page is what is called as horizontal solutions. So you will have human resource solutions which have cross-vertical application. Naturally, there are many, many of these. And then you have a lot of enabling and management tools which target software development itself. So, there is a lot of SaaS tools or cloud tools which help you manage the cloud. So which help you manage your cloud infrastructure, which help you manage cloud capacity, which help you monitor cloud performance or SaaS performance, user utilizations. Then there is a lot of SaaS around development or DevOps. There is a lot of SaaS around monitoring, a lot around testing, security, and storage. Right. So which is basically SaaS on SaaS in some ways, because you are really addressing the IT infrastructure and applications through a SaaS platform. Now, if you look at the India landscape, right, we've kept the framework exactly the same, but the India landscape is less congested than the global landscape. Of course, both of these are obviously illustrative lists, but the India landscape is actually becoming, quite congested quite quickly. And as you can see, the variety of SaaS businesses that have come out of India across horizontals, across verticals, and also at the bottom of the page around in what we call as enabling and management tools is actually quite substantial. Companies like Dhruva, which have become substantially big, Browser Stack, Lambda Test, HackerRank, right? So we're starting to see businesses, SaaS businesses emerge out of India, which earlier only used to be generally in the valley. And as I was saying earlier, every space has multiple spaces within, right? So this is the double click on CRM. If you see the previous page, the third row on customer relations, actually this is a double click on customer relations, right? Customer relations or CRM overall, or some businesses will call themselves sales automation businesses, actually has a lot of other things underlying, right? You have email tools, you have web content managers, you have social media managers, you have campaign automation software. Then on lead engagement automation, you have a number of businesses which do very specific work, which play a very specific role in the CRM value chain. Sales enablement, again, it is a very complex subject. There are players like BidSketch, which only do quotes and proposals. There are pipeline managers like Pipedrive or Freshsales. There are forecasting tools like Future Margin. There are Salesforce managers, there are automation software, and so on. And then you have a lot of conversational intelligence companies. You have reporting and visualization businesses. You have training businesses. You have businesses that specifically specialize in commissions and incentives. There are businesses which specifically gamify your sort of sales teams. And then you have a few software or SaaS providers like a Salesforce or a Zoho or a Freshworks, which will typically span a large part of this landscape, but even they would generally not be fully complete. And then you have some which will, like HubSpot or a Sugar CRM or a Lead Squared or an Extra Edge. And then you will have a few tools like Insightly, which play a part in certain part of this CRM value chain, but you cannot call them a full-blown CRM solution. And SaaS businesses can be truly global. Now, this is a real example of a hospitality management service provider we diligenced, and I'm using old data on purpose. But this is the actual profile, and this is a $6 million revenue company. There's not even MRR. And look at the business. Only less than a fourth of business actually comes from the US, which is where this company was, this business is actually located, and the business sort of comes from practically everywhere. Now, Indian B2B companies are also largely global, right? So I've only picked 4 very selective examples here. Large businesses we all know of: Druva, Zoho, iCurtis, Freshworks, Unifor. Most of these businesses derive around, on an average, 10% of their revenues from Indian operations. Most of these actually are growing much more rapidly outside India. Now, there are 5 ways to build a $100 million SaaS business, right? We'll demystify some of these terms very quickly, getting to section 3. But the y-axis is called ARPA. It's average revenue per account. This is in terms of dollars per year. The x-axis is number of customers that the SaaS company or a SaaS business targets. Now, you could, even in the same space of CRM, and even within CRM, if you look at automation, sales automation, or incentives computation, you can actually have different businesses. You can have businesses which target 10,000 customers but charge only $10 per year per user. And there are businesses which will have 10 customers, so 100 customers, but will go after larger accounts. And so that's why most SaaS businesses, fortunately or unfortunately, look very different and feel very different from one another, even though they all seem to be CRM or they all seem to be HRMS and so on. And let me give you a live example. If you look at CRM, which is a $42 billion space, you actually, and this is, we've plotted on the y-axis, the ARPA that some of these companies have, right? And x-axis is the number of customers that these businesses serve or that these businesses target. And in the CRM market itself, you have solutions like Salesforce or Oracle Cloud or Microsoft Dynamics who focus on large enterprises. The fewer customers who can adopt those solutions, typically expensive solutions. And on the right-hand side, you have players like Copper or Pipedrive, which are specific tools. They're very cheap to deploy. The Pipedrive would be a $7 per user per year, or a $49.99 per company for 5 users. It's typically substantially cheaper, but target a very large set of customers. And this is one of the reasons why we cannot benchmark these businesses like for like, right? When we do a diligence, it is actually unfair to benchmark a Copper with a Salesforce or with a HubSpot, and vice versa, right? And that's the reason why also smaller SaaS companies or SaaS businesses exist, despite a winner. For example, Salesforce in this case, despite a winner being in the market. This also means different pricing, right? So the pricing for different type of enterprises in different sectors, their paying capacity for very similar applications, this is for CRM, is very, very different. Again, I'm not going to present sort of the details here, but just for you to appreciate how proliferated the customer landscape is and how proliferated the use cases are, which give birth to so many SaaS businesses, even in a similar landscape. And also the TCO varies depending on what vertical I am in, depending on what use case I am in, depending on what applications I want out of the SaaS tool. And don't read the numbers, we've actually dummied them. This is from an actual diligence. But the TCO across competitors varies depending on what user you are referring to. A medium-sized firm with a 150 user base will typically spend much lesser per user. A larger enterprise will have more evolved needs and will typically spend much more compared to the other enterprises. And so in India, we typically a very, very simplistic view of the world. You have four broad types of SaaS players. You have India for India innovation and India for the world. And then you have SMB focused and large enterprise focused. This is a very sort of high level, sketchy representation or segmentation of businesses in India. Smaller your customers are, the more B2C-ish or more retailish your GTM becomes, right? So if you play on the right-hand side of that exponential curve we just saw, if you look at Zoho, that's the reason why Zoho is very prominently on hoardings and banners, while some of the larger businesses, you would not see them. You would see them going more digital, or Salesforce in many cases would actually target accounts much like how Microsoft or some of the other sort of traditional software providers used to. Now, also one thing is very important is as customers grow, their needs evolve. So this is now I'm adding sort of another layer of complexity, right? So one, the verticals are different. Secondly, we said the size of businesses are different. Thirdly, we said their use cases are different. Fourthly, is that their needs themselves evolve, right? As an organization starts small, this is again for lead management, just lead management CRM within the broader CRM umbrella. You will see that a business that is typically sort of $5 million of revenue wants very different application tools servicing from their SaaS product versus a $5 to $20 million enterprise, which is then sort of further different, which then further goes to $1 billion. This, which is why you see this, many different SaaS players playing in the same subspace because their product is more defined and more the product market fit is much stronger with a certain application. And so the SaaS becomes very fragmented, right? This is now a real example where we actually looked at some of the sales management tools or SaaS products, and we marked them against key purchase criteria, and you would see that actually Salesforce and HubSpot actually do not fare as well. And the reason they do not fare as well, we're not saying that Salesforce is an inferior tool compared to a Verity or a Velocify or a Pipedrive or a Squad Stack. But what we're saying is that for a certain vertical and a certain type of businesses, certain size of businesses, and for a certain use case, a certain tool might actually work better than a bigger, broader, more sophisticated integrated solutions like a Zoho, Salesforce, HubSpot, or Freshsales. Often they're very complex to implement. Often they're very expensive to implement. Often their product is not flexible and not too customizable. And often, they do not give you a lot of flexibility in how you do contracting. Now, one thing that we talk about, just to round up this conversation before we get to the SaaS basics, is that the addressable market, I think what all this sort of last 10-15 minutes that I've spoken about, what we're really saying is that the addressable market for SaaS needs to be looked at very, very differently and in a very nuanced fashion. This is again a real example from our diligence that we did in the sales tech space, where we tried to find the addressable market for sales tech depending on the specific type of customers the company addressed. And this is very different than saying, CRM is a $42 billion space, because the market might nowhere be close to a $42 billion, right, for a typical company. Also, again, I'm just sort of showcasing some real examples of our work. If you just looked at SaaS adoption, depending on sectors, depending on employees, and we have a lot of these fact bases sort of readily available with us, but the penetrations of SaaS adoptions are very, very different. And so as you look at the addressable markets in different SaaS verticals and different SaaS enterprise sizes and then specific use cases, you'll basically look at the penetration today and take a view on what the penetration could be, which will then lead to a more accurate estimation of the addressable market today and what the market will be going forward. Now, the slide I skipped, it's very important. Timing is very important. So we've all, heard news around Gupshup's recent investment in Gupshup. Very interesting play, right? It's very much a part of CRM. Within CRM, marketing automation. Within marketing automation, they do specific type of automation. And this company, for the last 3 years, if I looked at FY16 to FY18, was fairly stagnant. Whichever metric you looked at, revenue, expenses, ROA, ROE, fairly stagnant. And then, as the underlying ecosystem around WhatsApp marketing, influencer-led marketing, social commerce, as the underlying use cases grew, the company's basically been on a very solid rocket ship, which then, all of us know it's raised a substantially bigger round. Now, how do we spot SaaS winners? Like, let's talk about that. Now, investors love SaaS, right? The reason all of you are here in these large numbers is that SaaS becomes big very quickly. Most of the large global businesses, and I've taken some horizontal businesses and vertical businesses here, most of these businesses actually raised a lot of money much ahead of time when it comes to revenue. And as we talk about the basics now, you will see why that is the case. But it's actually not uncommon at all for SaaS businesses to show an exponential growth and raise capital substantially ahead of time, versus where their revenue is. But also, the size of the vertical might not be enough, right? So the valuation in SaaS businesses is complex. We've taken real estate in this case, and there are businesses like rheology, which are not valued that richly, and there are businesses like Zillow, which are valued very richly because of the network effects the business has, the kind of commerce opportunity that the business has, and the kind of role that technology plays, in that business. Also, typically, median SaaS multiples, 8 to 10x, on their last month ARR. We will demystify those terms. Revenue is actually a somewhat false concept when it comes to SaaS. We'll talk about why valuation should happen on ARR and not on revenue. But you could see SaaS deals happening at last month's ARR, and goes all the way up to 15x. And it is not unusual. Most successful businesses globally, right from a Shopify to MuleSoft to HubSpot and so on, actually raised money at those high multiples. Also, SaaS businesses, their median ARR, they typically get ready for an IPO, at a median value of $280 million US. But you could IPO a SaaS business, at $100 million ARR mark also, which is sort of very, very value creating. Now, let's talk about how SaaS makes money. So SaaS makes money like with all businesses. Very simple: acquiring customers, retaining customers, monetizing customers. So why is it so different? Why is the SaaS diligence so different compared to other diligences, right? So typical SaaS P&L, I think we have to understand how SaaS businesses make money from customers. So SaaS businesses face substantial losses in the early years. And this is because of the heavy investment or heavy negative cash flow they have to make at a customer by customer level. In fact, the more successful a SaaS business is, the more money it will lose, because they are acquiring more and more customers who are for example, in this particular example that you see on the page, they are losing money on a cumulative basis till month 13 and only start to be cumulatively cash flow positive after a certain month. And so if you see the chart on the right, we have basically plotted for the same business simulation to say if this particular business was acquiring 2 more customers every month, what would its P&L or cash flow look like? If it acquired, which is the blue line, if it acquired 5 more customers per month, what would the cash flow look like? And if it acquired 10 more customers per month, what would the cash flow look like? And you see that the green line is going to give you exponentially better returns in 5 to 6 years, but the business will guzzle more capital and for the right reasons, because it is acquiring customers more rapidly. Now, the SaaS unit economics is actually simple. It's actually very similar to B2C, which is, you look at LTV, you look at CAC, very, very simple concepts. But I think the important question to ask is, can I make more profit from my customers than it costs me to acquire them, right? Which is roughly the question we ask in B2C, but B2C, the stickiness is not there, right? So often, often you will end up spending a lot of money on reacquisition of the customer, right? Let's actually, double down on this concept. Now the SaaS ARR, and we will connect it back to LTV. Just bear with me for a few minutes. The SaaS ARR is basically 3 things. There is new MRR, or there's basically new customers that you acquire, plus expansion MRR or ARR, which is basically how much more money are your existing customers spending on you, minus churned MRR or ARR, which is basically customers you have lost. Right? Very simple. ARR is annual run rate, annual recurring revenue, whatever you want to call it. MRR is monthly recurring revenue. ARR is simply MRR multiplied by 12. Now, let us demystify this a little bit more. So the ARR is basically MRR into 12. And the way you compute MRR is actually you look at current MRR. Now, a lot of SaaS businesses will confuse you with a term called bookings, right? Sometimes they will sell prepaid plans. Sometimes they will give bulk discounts and accumulate revenue ahead of time. Whenever we're diligencing a SaaS transaction, we should decompose the bookings into MRR. Right? That's point number 1. That's one of the very common mistakes that investors make. They end up overpaying for the business because they think that bookings is MRR. Bookings is not MRR. Secondly, you do new business MRR, which is new revenue. Again, MRR, not revenue. New MRR that you gain from new customers in a month. Now, this new customers mean net new customers. You might also have reactivated customers. Some SaaS businesses include reactivated customers in current MRR because their logic is that those were my current customers. We typically, when we do diligence in a purist way, we typically believe that reactivations is new business MRR because you've had to spend money to reacquire the customer. Then there is expansion MRR, which is amount of money you gain, again, MRR, gain from upgrades and add-ons. You could have sold some additional services, you could have sold some additional sockets, additional API integrations, additional containers, right, and whatever. Then there is contraction MRR. Just like some of your customers are expanding the scope of their business with you, there are some customers who are contracting the scope of the business with you. That contraction might be happening because that business is shutting down. That contraction might be happening because they have fewer users for your service, et cetera, et cetera. And minus, again, the churned MRR, which is the MRR that you have lost because of a customer churning out. So this is the first very important concept in understanding SaaS. And the reason why this is important is because you want to track MRR and you want to value a SaaS business based on MRR. If you did the same thing on revenue, you basically have a completely bungled up number because the revenue could be, it could be front loaded because of advanced collections. Your churn could be back loaded because a certain customer's user profile dropped, their users are dropping, but they've already paid advance and whatnot. So revenue actually is not a great metric when we're looking at SaaS transactions. Now, the customer renewal rate. The reason I'm getting to renewal rate is because we want to ultimately build up to the LTV or the CLV, which is customer lifetime value. So the renewal rate is very simple. It is the percentage of customers who renew their subscriptions at the end of each subscription period. Very, very simple. There's no rocket science, on this, right? And so we spoke about renewals, which is sort of existing MRR. Now your upgrade, your MRR expansion MRRs can be very different. So for different type of businesses. So what I have, we've taken a collection of businesses which were less than $5 million of 2017 ARR, and we've said what is the percentage of their ARR that came from upsells and expansions. So for smaller businesses, this number typically is between 10 to 30%. For very large businesses like a Salesforce, a HubSpot, Workday, this business, this number could be as high as 30 to 60%, right? So that is the kind of, or Twilio, for example, is a classic case. I have some slides later in the deck. Twilio makes a lot of money just by upsells and expansions. They do not need to keep acquiring new customers. So very, very important to understand the upsell and expansion revenue. Increasingly, VCP funds are valuing SaaS businesses that have a network element to them, which is what drives their expansion MRR. So for example, a business like Slack, Slack is just an enterprise messaging platform, but it has a lot of expansion opportunity by way of integration, custom apps, workflow automation, and so on. And you pick up any of these businesses, you pick up LegalZoom, pick up Zillow, pick up Xero, pick up GoDaddy, right? A lot of these businesses, started as SaaS, but then have evolved as SaaS as a platform where you can write more apps, which is how Salesforce.com came up in the first place, SFDC, and then also have a marketplace or a commerce element on top, which then creates massive upsell and expansion opportunity. Now, we spoke about MRR, we spoke about ARR, we spoke about the different types of MRR in a typical SaaS business. Now, there is also churn. Churn as a concept, the opposite of churn is retention. The churn as a concept is where it unarguably the most important concept in a SaaS transaction. So there are three types of churn. There is logo churn. Logo churn is when you're losing customers. Best in class logo churn. Yes, sorry, I think somebody raised their hand. Vishita, yes. Do you have a question? If you type in your questions, guys, I can see them in the chat window. So I will actually include them in my commentary, if there's a question on the chat window. So, logo churn, typically logo churn should not be more than 2% a month, right? If you have more than 2% of logos attriting every month, you have a problem. Surely you have a problem. Gross dollar. So, okay. So the question is difference in churn for enterprise versus SMB. Yes, we will address this when we get to the fourth section. But, I'm right now only explaining the concepts and the definitions. When you actually do the diligence, you would end up computing MRRs, pricing power, upsells, churn, NDRs. You will end up computing them for each of the constituencies, product market constituencies that you serve. So your enterprise churn rates will be very different than an SMB churn rate. So we will address that question in the fourth section. Then there is gross dollar churn. Gross dollar churn is revenue that you are losing because of logo churn, and also revenue that you are losing due to downselling. Right, divided by the ending revenue at whatever the n minus 1 is. Now, the gross dollar churn should typically be less than 1% a month. Then there is the concept of net dollar churn. Net dollars are, of course, the gross dollar churn, but compensated by the revenue gain that you are able to do through upsell. Now, best in class net dollar churn, of course, is negative. This is also called NDR, which is net dollar retention, in which case, you basically say a net dollar retention should be greater than 100%. If your net dollar retention on a month-on-month basis is more than 100%, it only means that the company will be able to preserve revenue despite losing customers. If your gross dollar retention, GDR, is more than 100%, this means that the company will preserve revenue, even without having to compensate through upsells, which is fantastic, right? And if your logo churn cannot be more than, logo retention cannot be more than 100%, that doesn't make sense. But a high logo retention obviously means that you are in a very sticky service. Now, go to the, sorry, I got a little stuck here. Okay, so a negative ARR or MRR a churn can significantly boost revenues of a SaaS companies. No prizes for guessing this, it is obvious, right? So if you have negative churn happens when your expansion revenue from existing customers is more than the lost revenue from the churning customers. Very, very, very simple. Now, there are, of course, many levers for this. You could increase users, you could increase pricing, you could increase usage, right? A number of levers on how you can manage this. But this is sort of, as simple as that. Now, if you look at a typical SaaS company, a typical SaaS business, right? You would typically see billings, or what I was calling as bookings. As I said, billings and revenue are different things in a SaaS business, which is billing is based on annual contract values called ACV. Revenue can be booked without having been invoiced. So you should not look at revenue of a SaaS business. Then there is cost of goods sold. Cost of goods sold will typically be fine, but it will typically be very high. In fact, the largest component of COGS is typically hosting expense in a SaaS business. But again, beware, because COGS is a P&L item, and revenue and bookings is not necessarily representative of a growing MRR or a growing ARR. So very, very important to understand what to read in a SaaS business P&L. This is how typically SaaS businesses will look like. When you look at their dashboards, you would see MRR bookings. They will show you bookings. You will see ending MRRs. You will see MRR bookings over time. Expansion MRR, churned MRR, customer churn. So it's very important to demystify and stay focused on MRR and consequently ARR. Just stay focused on that as we're doing SaaS valuations. Typically also show bookings are growing, deal sizes are growing. Now, deal sizes don't mean much, because if you did a price discount, your deal sizes could go up, right? Because you're selling bulk offers. One concept that is actually very important is ARPA. So if you look at average MRR on an account level, multiply it by 12, that is actually a great metric to see what your sort of SaaS company is positioned as. So while aggregate bookings could increase, this is a real example I'm using, aggregate bookings for this company from new customers was increasing, but their ARPA was actually going down because they made pricing changes to onboard more customers. So you won't see that in the deal sizes, but you will need to double click and understand why this is happening. Now, why is churn so important, right? We are fretting over churn, we are fretting over MRR. Like, this is not how we are used to doing B2C valuations. This is not how we are used to doing ITES companies. The reason why churn is so important, because churn of MRR makes all the difference. Of course, negative churn is fantastic, because that means you have a lot of net positive bookings. No customers are going, you're acquiring new customers. That's fantastic. But the sensitivity of churn to MRR is very substantial. So if you look at the right-hand side, you have a business where the MRR that you will end up in 5 years, x-axis is months, y-axis is MRR. And you will see that at a minus 2.5% churn, you are awesome, right? You started very small, you will have a very large MRR, for this business. At a 0% churn, that's not bad, right? You get to a nice sort of $4 million here in this illustration, $5 million perhaps. But if you are a 2.5% churn, right, or if you're a 5% churn, you pretty much have a business that is not growing, and that business is not going to get a lot of valuation, even though the MRR seems to be growing. It is not a good quality business. And typically you do this, analysis at a cohort level, right? So you'll pick up a cohort of customers who are joining in a particular month. You would see whether the churn is stabilizing or not. You should see two things. You should see that the churn should be stabilizing, which means you are not seeing a secular decline in number of customers in a cohort, which means that your product either has limited utility or your product does not have stickiness. Secondly, you should see that's improving. Your churn rates should be improving as your cohorts are improving, which basically means that your product is becoming stronger, right? Those are the two things. So, a lot of investors sort of check with us on churn benchmarks, but I always get very confused because the benchmark per se actually does not mean much. What you need to see is the pattern of churn, and then double click and understand the reasons of churn. And so, it is not surprising. If you look at churn, and remember, we spoke about three types of churn. We looked at logo, we looked at gross dollar, we looked at net dollars, right? So the logo churn curves should basically be progressively becoming better, which basically means that your customers or your logos or your accounts like the product. This is a typical, again, this is a sort of a real example from one of the diligences we did. Look at the MRR that was written. This is a phenomenal example of strong negative churn. Like, look at the MRR, right? The MRR is growing rapidly across cohorts, which means, this company, of course, we double click. This business was expanding current accounts. This company was not not seeing too many downgrades in the subscription. And this business was not seeing too much of logo churn. And again, I'm reiterating that this analysis has to be done at an MRR level, not at a revenue level, not at an ARPA level. That will also be wrong. You should do it at an MRR level. Okay. And so if you look at, this is interesting, right? So, the quality of a business, right? If you had to look at one metric in a SaaS company, if you had 5 minutes to do a diligence, I would basically look at net dollar retention, right? We've spoken about MRRs, we've spoken about ARRs, we've spoken about LTV CAC, we've spoken about NDR, GDR, logo retentions, LRs as it's called. But at the end of the day, the NRR, net revenue retention, is also called NDR, which is net dollar retention, is what every successful SaaS business has. And what you see on the right-hand side, I literally sort of flicked this off the internet, looked at a summary of S1 returns of top 40 SaaS IPOs globally, and look at their net dollar retention, right? Look at their 1 year prior net retention. Look at their 2 years prior net. Look at how the net retentions are growing massively. And the best businesses that get valued on the street significantly superior way are the ones which, of course, having less than 100% NDR is not bad, but your median for successful businesses or top performers is in excess of 100%. And different types of SaaS businesses, interestingly, will show different stickiness. I'm not going to go through the details of this slide, but just because something is SaaS does not mean their NDRs will be good, or their or their GDRs will be good, or LRs will be good. Yeah, Bhuvan will talk about rule of 40 shortly, and I'm coming to some sniff tests, very quickly after this. So, guidelines for churn analysis, a net revenue churns more than 2%. Indicate that there is something wrong with the business, right? This means either the product is not meeting customer expectations, or the product might not be sticky, or the customers are not able to adopt the product, or the customers might not be suitable for the product in question, in which case the TAM might be overestimated. Customers that are being targeted are probably going out of business very quickly, or the business model is just not conducive to expansion revenue, which is by your revenue churn. So revenue churn, net revenue churn of more than 2%, you should be very cautious looking at that transaction, or at least understand what's going to change. That's going to change the NDRs to a greater than sort of 76% plus. Valuation of SaaS businesses, very easy. LTV CAC should be more than 3. Typically, if you've done a good job of NDRs, GDRs, if you looked at cohort-wise churns, you would typically not make a mistake. Now, a lot of SaaS businesses do monthly contracts where MRR calculation is very easy. A lot of businesses also now do annual or multi-year contracts, in which case, do the same analysis on ARR because MRRs could be very, very excruciatingly painful to decipher and parse out. And ARR sort of serves the multipliers to see fully well. So I will go down. These are just some examples on LTV CAC, how it typically trends for a good SaaS business. LTV CAC ratios become better. They cross 3 over time. Months to recover CAC reduces. Now let me show you some very sort of interesting how does this whole LTV CAC come into action, and why were these sort of concepts of MRR so important? Why was churn so important? Now this is a real example of HubSpot. This was the time when HubSpot, if you look at Q1 of 2011, the LTV CAC computation for HubSpot was as follows, right? You had a CAC of $6,000. Their MRR churn was 3.5%. Their average MRR was $429, and their software margin was 83%. So, you can do the math, but the LTV was actually sort of, MRR into 12 into 83%. That is LTV. It was a $10,000 LTV company, very successful business. But if you did the math, LTV CAC was 1.7. Within 6 quarters, they moved the business. The CAC stayed the same. Actually, CAC grew a little bit. The MRR churn dropped materially because the product got developed very quickly. The average MRR grew a little bit, which is great because this means that the product is evolving and there is some more expansion MRR coming into the picture. Software margin pretty much stayed the same. It's a variable cost generally with very limited sort of some benefits of hosting scale, but not too much. And LTV, purely because of MRR churn, LTV became 3x of what it was 6 quarters before. And so you're suddenly looking at a business which was LTV CAC of 4.7 from a business that was LTV CAC of 1.7. So very, very important to take a very nuanced view of the SaaS business that we're looking at, right? Now, my last concept before I actually get to diligence, we'll talk about some of the questions that have been put in the chat box. Very important to now double click. So we spoke at a high level about MRR, ARR, NDRs, etc. But, how do customers come? Like, how do customers get acquired in the first place? There is obviously a very clear funnel. There is a term you will see used quite a bit called lead velocity rate. So what is the velocity at which you are able to get leads? So you literally have to start with campaigns, to visitors, to conversion, who sort of, basically percentage of businesses that are getting to trials, trials further getting to close deals, and you can do by lead source. You will basically do an overall conversion math. And you will typically have dashboards of this kind with any good SaaS business. And this is a real example of a sales funnel analysis that we did channel by channel. What you see in the columns are channels, and then you have the funnel, and you see what parts of the funnels are drop-offs happening. And this gives you very good insights on whether you need to put money in customer acquisition at the top of the funnel, whether it's about demos, whether do you need a sales team, and so on. I will skip this. These are sort of slightly complex concepts, but there are a lot of just like given the time, I'm trying to skip sort of details, double clicks on how expansion happens, how pricing happens. There are many different models on pricing. One message I would give here is that the usage-based SaaS companies are increasingly seeing better valuations. So if you look at businesses that are sort of pricing based on usage, rather than just users, or rather than sort of sort of bulk pricing, they generally perform better on revenue growth, on net dollar retention, on EV by revenue multiple, on revenue scale that they achieve, on gross margins that they have, and also on the rule of 40, which we will shortly talk about. Okay. Net dollar retentions we already spoke about. I'll not. I would just show this one case study and go to the fourth section now. But this is an example of how important pricing is in ZocDoc, right? So ZocDoc is an interesting sort of SaaS provider. They basically were the Yelp of healthcare, right? Used to do flat fee pricing. I used to charge 3,000 annual flat fee to healthcare providers. Moved to usage-based pricing, which accelerated their land and expand. Their network grew, their churn went down, their sales productivity went up 4x, and they saw their first ever profitable quarter in quarter 4 of 2019. So again, today's discussion, we cannot possibly do justice to all these micro concepts. But if you're interested in talking about channels, margins, costs, pricing, we'll be happy to sort of set up separate conversations. Right? Usage-based, Snowflake. So anyway, let's now talk about the diligence framework, right? So, value creation in SaaS happens in 3 ways. You either be a category leader, or you own a certain vertical, or you extend and extract value out of the network, right? Essentially speaking, those are the 3 broad levers that a SaaS business will unlock in terms of value creation. And they will typically go through the 6-step journey. You would typically have a SaaS business which is leading a category. The GTM is great, their onboarding is very scalable, it's almost automated. Their product UI and architecture is robust, it's scalable, pricing is stabilized. They are typically global, or at least ready to go global. They would typically then move to hyperscale locations, shift to cloud completely. They will have backend systems where you can meter your users, where you can monitor usage, you can unlock a variety of channels, including self-serve channels, very, very deeply. You'll win the control points. This is very, very important because you want to get integrated in customer systems, right? You want to become a part of their systems of record. Once you are a part of systems of record, it's really sticky. If you are a part of systems of transaction, somewhat sticky, but you can still be. A payment gateway by design is a part of systems of transaction, but it can be edged out because the better payment gateway could just come and it's easy to sort of plug in and plug out. Also front office, and back office. If you truly own the user, and if you truly own the admin layer in the SaaS tool, you will basically you will see a very deep degree of stickiness. Expand the headroom. You'll typically be able to go to new segments, new geos, and sometimes other verticals if you're not talking about a vertical SaaS. Expanding through the value chain. So this right to win through either very tight workflow integration, which is what Slack did, which is what Druva does, right? Very deep sort of integration of data, very strong account ownership. Again, Druva as a company, has sort of a very multi-layered account ownership approach. And then they would typically sort of follow the money up, down, and across. So you will make money out of your suppliers, you make money out of your employees, consumers, third-party services. That's how expansion and resale happens. And then you have sort of overall monetization, in terms of functionality. And if you then just follow the workflow, right? You're saying, okay, I am right now doing, sales marketing automation. Can I start to also deploy marketing dollars on a Facebook, right? Can I bundle, can I enable you to run campaigns and monitor campaigns? Can I then also monitor campaigns and also optimize using analytics and so on, right? So there is a very deep, desire to basically acquire sort of merchant spends. And there is a concept in the SaaS world of TAM sharks, right? So, when a SaaS company becomes big, it basically becomes a shark on the TAM, expands the TAM and starts to eat the TAM, because as we saw already that the landscape in every function and in every vertical is very, very proliferated, much more than what you would imagine. Now, going to, sorry, screen stuck again. Okay, SaaS companies typically struggle at 2 points in their journey, right? So what we did here was we looked at a large database of SaaS companies and looked at their growth rates, average growth rates and median growth rates. And one of the things that we see is that between $5 to $10 million of ARR and between $20 to $50 million of ARR, we see some stagnation in a SaaS business. Otherwise, they grow very well. And so if you are evaluating a business at these two inflection points, important to sort of double click and understand whether the inflection to the next stage will happen or not. Now, there is a question also in the chat box. How do you very quickly qualify a SaaS business, right? There are 5 key sniff tests that you can do. Number 1, simply look at gross margin, right? Now, even though I said revenue is not that important, revenue is not an accurate predictor of the quality of the business, but if your gross margins are less than 70%, I would be worried, right? Because then I would question whether it is even a SaaS business, right? So that's one. Second is LTV CAC, right? Which is simple, profit per person sort of by churn rate and sort of number of customers acquired, upon marketing spend, right? Whichever way you do a quick math on sort of profit growth. I mean gross profit growth. So gross profit growth to marketing spend is sort of your very classic LTV to CAC. The third is there is a concept of the magic number, and the magic number, is interesting. It's a very unique SaaS concept. It's a ratio which shows yearly recurring revenue growth, which means ARR growth, divided by sales and marketing dollars spent in the previous year. Now, this probably does not mean much very easily, but what it shows is that the more sales and marketing dollars I'm putting, is it incrementally and disproportionately fueling revenue growth? Now, this is just a magic number. This is by no means a determinant of success. This is only an indicator of success. And the reason why we did not include magic number in the previous section, rule of 40 in the previous section, because these are just sniff tests. Just because rule of 40 is followed or not followed does not mean much, in terms of the quantity of the same. Rule of 40, it is basically revenue growth rate of the company plus profitability margin should be equal to or greater than 40%. Now, it generally measures the balance of growth and profitability. Could be, it is, I will show you some data. It is not always followed, but a lot of SaaS investors just love using this metric. And then there is churn. If your customers are churning, and when I say churn, I meant customer churn, logo churn. If your customers are churning, that's often a sign of it's a sign of a potential problem in the business, and you'll want to double click on that. Now, what are the benchmarks here, right? So gross margin to all those 5 metrics, matrices that we spoke about, bad, good, best, we have seen a range. Really speaking, anything less than 25% on rule of 40 is bad. Anything greater than 40% is great, but honestly, a lot of good SaaS businesses have shown rule of 40 as 30, and they have actually done very, very well. Gross margins of less than 50% are atrocious. 50 to 70% are okay. Greater than 70% is very good. LTV CAC, 3 to 1 great, 4 to 1 fantastic. That also shows a maturing business. 1 to 1 or 1.5 to 1, I would basically need more reasons to believe before I invest. Magic number, self-explanatory. Churn rates, self-explanatory. Right. And so this is, I know there's some hands raised. I will actually leave some time towards the end for questions. But this is, we literally took, and this is very easily available on the internet. We took top, 30 SaaS businesses globally, and we plotted them on the rule of 40. And if you look at, there are actually very few businesses that follow the rule of 40, right? So Adobe, Shopify, Twilio actually follows that quite nicely. So some businesses do. Others like Workday, HubSpot, several other businesses that you can see here in the orange, they generally follow the rule of 30, not 40. And then there are actually other businesses, be it Box, be it DocuSign, be it Splunk, Upwork, right? So some of these businesses have not followed the rule of 40, and there is nothing wrong with that because it is just a function of how mature the business is. And I'll show you some examples. Sorry, just bear with me for 2 minutes. And for more complex businesses, this was a question also that was put in the chat window as to how you do this analysis, right? How do you compute global versus internet, global versus India, verticals versus this, enterprise versus SMB. So the concepts we spoke about, ARPA, net MRR churn, LTV, CAC, ratio, months to recover CAC, customer engagement, employee retention. All of these metrics and some of the other metrics we spoke about need to be looked at separately for verticals, geographies, and account sizes. And I'll show you one real example of how we did that. This is a real example of a diligence we did where we calculated logo retentions and NDRs by vertical separately, account sizes separately, and geographies separately. All these numbers are dummies, so don't read too much into it. Directionally, they're correct, but this is the kind of analysis you will need to do as we're trying to build the B plan, right? So you cannot just look at a business, do sort of a cohort. If the company is targeting heterogeneous segments, the analysis in the diligence will need to be heterogeneous, and the business plan that we would build up would also be built up heterogeneously. Okay, sorry, I skipped a few pages, but so what makes a SaaS business successful? We typically, of course, I spoke a lot about numbers, but strategy, managing costs, account revenue, we spoke about some of that, customer acquisition, customer success, talent and capability, product excellence. So these are all underlying dimensions or underlying attributes or capabilities of a SaaS business that will lead to those outcome metrics of higher ARPA, better LTV, CAC, world-class sort of NDRs, and so on. And so typically, the methodology that we use to diligence a SaaS business is actually pretty comprehensive. We broadly look at 4 broad dimensions. So there is performance, which is all the financial metrics and customer metrics. There is offering, which is robustness, security, product has features and design, engineering strength, customer service, total cost of ownership from a customer perspective. Then sales excellence, right? How do you basically acquire customers? Account quality and growth, which is where all your MRR double clicks, ARR double clicks happen. Expansion, upsells, all of that. Retention and churn management, and talent model. One of the things I will not do too much in a SaaS deal is worry too much about NPS. Actually NPS and customer satisfaction does not really count for much. It is just one of it's probably the 30th most important metric, but there are 29 better metrics than looking at NPS. Also, it is important to understand what kind of a company you're diligencing. So not all of these metrics are important, for all businesses. If you are a super early stage company, you will rely on bookings. You will actually not worry as much about MRR. You will look at traffic funnels. You will look at funnels a lot more deeply, right? You look at customer engagement and user engagement a lot more deeply. And then as you grow, early stage companies, some of our churn, MRR, customer count, those concepts become important. Growth stage companies, you start to look at cohorts because you have the data to look at cohorts. You start calculating CLVs. You start looking at upsell, cross-sell, downsell. You start looking at average revenue. Start looking at what proportion of invoicing is upfront, right? And overall, for very large businesses, the diligence becomes fairly complex because market penetration, market share, deferred revenue, how much revenue is deferred, EBITDA. You start to sort of do a lot more quantitative diligence. As the business. I showed this already. I will actually skip some of this in a typical SaaS business. This is how we sort of build up a B plan. This is again all dummy data and also mask data, but the typical B plan would be sort of geography wise, account wise, look at the life cycle, apply the ARPAs, apply the retentions, apply the contribution margins, and then calculate the LTVs. Typically, employee costs, we have a lot of ready benchmarks on employee costs, for example, how they trend over time. We have a lot of ready benchmarks around how EBITDA gets built up over time. Sorry, I've masked obviously all of this for obvious reasons. This is from a very recent diligence. Uh, and also we've sort of ready frameworks and benchmarks around how do you diligence a SaaS business technically, looking at performance, support, compatibility, regulation, security, privacy, and so on. Uh, and then also operational diligence on sort of complaint resolution, agent statistics. So I spoke about all of that on that one page 3 framework, but this is just to show you an example of, how deep one should typically go when diligencing a growth stage, at least a growth stage SaaS transaction. And so I think my last page before we open this up for questions is most common roadblocks, apart from the numbers, MRRs, churns, all the good stuff we spoke about. Strategy and pricing. Often a lot of SaaS businesses stumble at this stage. GTM strategy, they're not able to go beyond the product market that they are operating in, especially not able to go beyond a certain geography. And surprise, surprise, but a lot of SaaS businesses also struggle with managing finance, talent, and operations, which gets them to stumble at that $5 to $10 million ARR and that sort of 20 to 50 or sorry, $30 to $50 million ARR that I spoke about. So I think that's what we had for today. That wanted to, and I know we're sort of right at the top of the 90 minutes, but I'm happy to stay on for another 30 minutes and take as many questions as you guys want. Yeah, sorry, I think I'll need to allow everybody to talk. Just give me 1 second, please. Yeah, please raise your hand if you want to talk, if you want to ask a question. We'll be very, very happy. Sorry, I'm just trying to see. No, I do not see it. That must be an old hand. Any questions, guys? Please raise your hand in the attendee list. I have this right in front of the screen, so I can allow you to talk and we can answer questions. Any questions, guys? Anything at all? Yeah, if you type your questions, yes. So a part of this deck will be shared, guys. I cannot share everything. Some of the benchmarks that I showed, I will actually purge some of those pages, but still a fairly large part, I would shortly share it. Anything else, guys? No, fantastic. I would say, thanks a lot for joining. We are, of course, very, very open to continue this conversation. Please do write to us. Any bouquets and brickbats welcome. And let us know if you need more details on anything. We'll be very, very happy to share perspectives. All the best. Thank you so much for for all the attention. I'm still here just in case. Okay, so. So there's a question. So for the attendees, guys, I'll not be heartbroken if you are leaving, but I'll answer the questions that are in the chat box. So there is a question: is there a way to justify valuation multiples? Most trades at 20x plus ARR. So look, if the underlying operating metrics are very solid, there's massive opportunity for geo growth, vertical growth. If you have applicability of use cases that can stretch across type of enterprises. In a stretch case, yes, a 20x ARR is possible. The transactions are happening at that value. If you look at some of the recent transactions, they have actually happened at a pretty substantial premium. But of course, you should sort of do it carefully. Generally, 10 to 15x ARR for the current year is something. For the last month is what the benchmark is. Now, again, I'm not an investment banker, so I'm sure investment banker can comment better on this. I think Bhuvan, so there's a question around what mistakes have we seen people make? So I think, actually lots of mistakes, right? I think the biggest number one mistake I've seen is people do not spend enough time trying to understand the TAM. They feel, oh, it's a CRM player. Okay, CRM is a big market. I got a Gartner report or whatever, IDC report. That is, you cannot be further away from the truth than that, right? So just because SaaS is nuanced and it is specific. So I think that's number one. Number two is is that I've seen the other mistake where people look at a SaaS business and very quickly dismiss the business, saying, "Oh, like, how will they compete with the Salesforce? How will they compete with Workday?" But that is, again, it's a big mistake. You cannot go more wrong, because there is a reason why Salesforce penetration is only 8 to 9% and not more, despite it being probably technologically the best product available. But it is not the best product for every customer segment and every customer size and for every use case, right? So I think it's important to understand. The third is that a lot of SaaS businesses are either very good technically but not very good marketing and sales wise, or vice versa. So I've seen a lot of SaaS businesses, fantastic product, but the founder is not able to sell, not able to retain a good team, is able to retain a very good product team, but not able to retain a very good sales team, right? Not able to activate networks, not able to create channel partners. Or I've seen businesses where the product is actually not that good. It does not keep pace, even though the founder did a phenomenal job, or the management team did a phenomenal job of acquiring customers and signing customers up in the initial stages. And typically, you would see that customer feedback will tell you that they are going to switch the product out as there, or you're going to see when you double click on the churn, you will see that larger customers are churning, which basically means that the use case or the product is not evolving. You're basically losing a certain kind of customers, and this is a very leaky bucket, even on a like-to-like basis. Then, we spoke about talent, operations, also not keeping pace on the product. So AI, ML, analytics, these layers have become very important. And so most good SaaS tools today provide these optionalities and additionalities. And these optionalities are actually fantastic because they accrue revenue as well. So, if you do not do a good job of this, then, you'll basically stumble, you'll falter. And then, of course, there are a few other things: governance, and a product stack not being very robust, tech stack not being robust, and so on. I don't know, Bhuvan, if that was helpful, but happy to sort of do a separate chat and go in greater level of detail. There was a question about enterprises, especially in the US, getting SaaS purchasing fatigue. No, not at all. In fact, most of the US SaaS enterprises are actually fairly underpenetrated. The beauty of SaaS is that they do not know whether it's an Indian company or not. When it comes to a large SaaS product with a high ARPA, yes, there will be some fatigue, not fatigue, but maybe perhaps some disillusionment. But most good SaaS companies, be it a Freshdesk, Zoho, CleverTap, whatever company you can think of, most SaaS businesses actually end up creating local sales teams. Or if you are a mid ARPA company, then inside sales can work as well. Also, there are a number of channel partners who Indian companies are working with. And so for US-based SaaS businesses, or for that matter, any other geography domiciled businesses, do not have fatigue. In fact, I would say that the boundaries between an Indian SaaS business and a US-based or US native SaaS business is actually blurring very rapidly. You look at Freshdesk, look at Zoho, look at Druva, these businesses, look at CleverTap, these businesses are growing outside India very rapidly. There was a question here I can see, which is around vertical versus horizontal versus infra. So I'm not sure what the question is, but if you ask me a more specific question, I can perhaps answer better. What else have I left out? Anything? No, I think. Yeah, I think there is a question on how does Zoho Freshworks compete with global CRM players. I think I've already addressed that. We can do a double click on this, but when it comes to implementation, execution complexity, feature sets, currency supports, customization, channel partners. Typically deploying a Salesforce solution is fairly expensive in India. And similarly in the US, a lot of self-serve tools sort of just grow much more rapidly. And so SAP, Oracle, Salesforce actually have a big problem because their technology and the product is actually fairly sophisticated, but also complex. So that's, and we can talk in detail. We can talk CRM, we can talk HRMS, we can talk ATS, whatever, right? We can speak about different spaces. Maybe that warrants a separate conversation. There's a question on what white spaces do we see in SaaS? Actually massive. The landscape that I showed, actually there's white space everywhere. DevOps, massive white space. Because remember, the technologies are changing, mobile devices are changing, newer use cases are emerging because of AI, ML, and analytics. So, none of the spaces, CRM, we are not done with CRM. There is a lot more that's going to come in CRM because new sales channels are opening up. And that leads to newer marketing automation, channel automation, etc., to come up, right? So there are massive changes. Remote workforces are a new reality since last year. And even though workforces will not be fully remote, the functionality of remote workplace still needs to be provided on a SaaS tool. And so, there is a lot of white space. How long do we take for a diligence for a growth capital? Typically 4 weeks. 4 to 5 weeks, I would say. We can do a rushed job in 3 weeks, but you won't get everything then. Definitely not the B plan, but the quality of the business can be assessed if the data is available. Typically 5 weeks is what we would expect if we have to do a good banged up job very comprehensively. So we also do, while we spoke about numbers, but of course we need to do a lot of customer chats, customer conversations, pipeline qualification, a lot of ITES type diligence is very, very, it takes a lot of time. Any other questions, guys? Yeah, so India SaaS is dominated by horizontals. Yes, absolutely. No prizes for guessing because the number of customers, vertical customers in India are actually far and few. So vertical SaaS, unfortunately, has not picked up too much. Also, vertical SaaS is difficult to scale globally because of different regulation, different domicile, let's say if you had a hospital provider focused SaaS tool, now the way the healthcare system works in the US is very, very different than how it works in India, right? And so it is that the concept of a nursing home suddenly becomes a private clinic in the US and so on. So vertical SaaS it typically gets restricted in terms of its TAM. And that's why you haven't seen so much of vertical SaaS in India, even though there are some promising players like Hotologics and so on, which have a little more global applicability. We also see players like Ace Turtle, Vinculum, Unilog, e-commerce focused SaaS. There is a little bit of global applicability despite being vertical. The hurdles in growing vertical is essentially product and regulation. Horizontal SaaS typically goes global very quickly. There is no infrastructural constraint per se, because if you're hosting a solution on AWS or whatever GCP, the Google Cloud Platform, or whichever platform you're on, all these platforms now have local servers. And so the data residency is not a big issue, generally speaking. At least we are not seeing that issue in our SaaS transactions. Margin for SaaS players will reach typical software margin? No, unfortunately not, right? So, fortunately not. So the margins will not go down because the CACs will come down. That's why the MRR concept is so important, right? So while the white space is huge, SaaS players will need to spend to do the land grab. So there are actually two spends, right? One is the land grab on customers. Second is evolution of the product. However, for both of these, fortunately, the operating leverage in SaaS is substantial. The reason why software margins used to become a problem Because the development costs and the revenues were actually front loaded. In SaaS, revenues are backloaded or a little more, let's say, uniformly loaded by design. And so, if the MRR curves and revenue will grow quite rapidly. Anyway, I can go deeper there, but that's sort of the short answer to why this will not, why the margins will not mimic software development lifecycle. Rahul's question. So IT services, we often look at increasing billing rates. That's correct. Oh yeah, absolutely, Rahul. So the SaaS companies are able to increase prices. However, this pricing is much less frequent, especially given the tenures or the contracts that you sign up. Typically, you'll be able to take pricing up once in 2 years. However, there are many other levers to increase pricing. For example, the add-ons, the containers, you could, if you are an email marketing automation SaaS company, you might, allow MailChimp and some of the other SaaS companies to integrate, and you might take a top-up revenue on that. You might add customizations. You might add money for API integrations. You will make customer servicing a little more costlier, right? And you will be able to price up, but you won't be able to take unit pricing up every year. Like we don't see that too often. We probably do that once in 2 to 3 years from a price point perspective. Have you seen, is it an important diligence item? Little bit. I would say this is of moderate importance. I would not bother too much if a SaaS business is not able to increase pricing, as long as the MRR growth and all those other good things we spoke about, are good. There's also a question on, do you like India SaaS selling to Indian buyers team? Yeah, we like it, but not too much. So some companies, some businesses where Indian selling to, in MSME, we like it a lot. Payment gateways in MSMEs or local ledger solutions or blockchain-based ledger solutions, we think some of those teams are very exciting because there are a very large number of MSME customers in the country. Also, when you do lower ticket MSME sales, your model actually has a lot of operating leverage by default. And so as you can actually do a very good job doing inside sales and so on. So we do like it, but in very small parts. But by and large, like for example, we don't like CRM, a large enterprise focused CRM company selling to only Indian businesses. That theme will taper out very quickly, and the TAM for that is not substantial. So I think that's the answer to that question. There's also a question, is there any ARR threshold beyond which? Yes, so $10 million is that threshold. I think generally if Indian businesses cross $10 million, they generally do well. By that time, they also are global generally. Now, having said that, there are transactions happening even for businesses whose revenues were perhaps $5 million, but their exit MRRs were crossing $10 million, and those charts were looking very pretty. So, so generally $10 million ARR is the benchmark on, if a company has crossed $10 million ARR, then we would say they've crossed their first hurdle, and next hurdle is $50 million ARR. Comparing SaaS versus, so we can, I already answered the EBITDA question. So we would probably do a session on IT services businesses, as a next masterclass, because that's also something that we do quite a bit. But overall, if the question is, IT services businesses trying to pivot to SaaS or product models, it is generally very tricky. We have seen it happen in some spaces. For example, in payment processing, we have seen this happen. In communications and customer contact management, we have seen this happen. Some analytics services providers, we have seen this happen. We've seen this happen because they have products or data or process flows which can be repurposed. In fact, if you come to think about it, SAP is a classic company which ultimately has become cloudified now. Microsoft Office as a product has now become Microsoft Office 365. So it is possible to move to SaaS, but it needs a pretty substantial change in mindset and substantial costs in retuning and refactoring the product for it to work very well on the cloud, right? On a non-private cloud setup. How do you assess risk of a SaaS business getting disrupted? Yes, very good question. See, so SaaS business, again, this is slightly qualitative. If you're doing a 15x ARR multiple in a business, yes, difficult to imagine this in a fast developing competition situation. Is a very use case based approach. If you're very sticky, if you very sticky use case, let's say DocuSign, a business that has gone on DocuSign, you already have a lot of signatories already on DocuSign. A lot of your contracts are archived on DocuSign. The stickiness of the service, even though it's a very commoditized service, the stickiness is substantial. If you have a business like Dhruva, it's a very sticky business because you have your data, you already have user access, user authorization layers that have gotten created on top of that business. So 15x ARR multiples are actually very okay. They're not over the top. But yes, you might have businesses like MailChimp. Now, a MailChimp tool could, yes, be substituted out. And so so you need to be sure that the product team and the engineering teams and the customer service teams are really up to it as they are acquiring customers. There's a question about which other regions do we see attractive on SaaS. We see Israel being very attractive when it comes to SaaS in terms of where you can find potential assets. The US, of course, very attractive. We're seeing Berlin, some of these hubs like Berlin and Singapore starting to see sort of interesting SaaS businesses coming out. But that's it. In fact, that's why India is a phenomenal develop in India and sell globally is a phenomenal SaaS theme. That we see in our diligences. Most of the diligences we have done have either been India businesses, now starting to see some Middle East businesses, or have been US based businesses. There's a question also on, is it easier for SaaS products for enterprise to build simplified version for SMEs? Moderately easy. The product needs to change, right? You need to, it depends on, that's where the technical diligence or engineering diligence becomes important. It depends on how modular you are. If you have 2-3 layers of abstraction in how you've architected that, then yes, you can water down your product very quickly and you can simplify the product very quickly for an audience or a user that is not so sophisticated. But if your modules are not modular, there was in fact the hospitality management services company example I gave. They were probably best in class on how modular their services architecture was. And if the underlying architecture is microservices and there is demonstrated demonstrated evidence of being able to customize the product across different customer sizes, then you are good to go. But honestly, most Indian businesses are not good at this because the product mindset in India, and very incendiary statement I'm making, but the product mindset and product talent in India is substantially suboptimal compared to what you see in the US. Yeah, a lot of M&A activity. Absolutely. I had some pages. I skipped those pages, but yes, lot of M&A activity. Expect a lot of tuck-ins, lot of M&A for Indian SaaS businesses. In fact, global businesses have acquired, be it a Salesforce, be it Atlassian, Jira, whichever solid sort of Workday, SuccessFactors, SAP, massive, focus on adding functionality and adding AI analytics toolkits, also going forward and backward in the workflow. Remember that slide I showed on success. So yes, expect a lot of M&A, which is why SaaS is so exciting, because even subscale businesses, if you have a good product, you can actually be an attractive acquisition target. European market, yes, European market is already becoming attractive. UK in particular, so yes, we are seeing some renewed vigor in European. The problem with European markets when regulation is very different because GDPR, etc., becomes very important. I've not seen too many Indian products being very ready. Secondly, currencies. Thirdly, languages. So the product, it's almost the same issue as with the vernacular manifestations of Indian applications in the B2B space, it becomes very tough. So the reason why Europe SaaS has not picked up is, I would say, more because our products have not kept pace. But for example, I showed you the example of the hospitality management provider. They are selling all across the globe, and very, very conveniently, because they have they have modularity in their architecture, which reflects. In fact, they had a fantastic metering solution in the backend where you can plug and play, and they had customer service team of around 230 people, all spread out across the globe and all remote workers. So it's a very different soul of the business, and very different processes, very different technology. It just needs a very different culture and a very global product mindset to start with. Yeah, so very good question. Also, so what does an investor bring to the table, and specifically, what do SaaS founders and managements like? So, one, fortunately or unfortunately, a lot of SaaS businesses will prefer investors with global reach and global scale more than pure India domiciled investors. And the simple reason for that is obvious, because at some stage they will need GTM support. There is also a lot of product learning. You would probably also need access to very strong chief product officer, chief talent officer, chief technology officer type talent, in the US and perhaps UK and some of the other global markets. And so I have seen some Indian SaaS founders not be very open to letting Indian investors invest large rounds or even lead rounds. However, if you get in early, I think that's the thesis for a seed, Series A, Series B type investments. If you get in early, you are basically in for some sort of substantial value creation. And so the ways to differentiate is, I think, one, demonstrating understanding of the business. If you talk revenue, if you're questioning bookings, or if you're feeling too excited about bookings and not worried about MRR, the SaaS founder at the end of the day knows that your sort of domain understanding of the space is not very good. Also having access, as I said, very important, and some proven success, if not in SaaS, but at least of having supported technology and product-based businesses scale up and create value and be able to do rounds, sort of Series B, Series C, Series D, and so on. That becomes, I think, particularly important. But beyond that, honestly, there's so much sort of value addition. I think global scale and global access is quite important, and most SaaS founders need a lot of product support, and sales and GTM support as soon as they raise their Series A. Hey guys, we have 2 more minutes. But I think a good flow of questions. Happy to answer maybe last 1 or 2 questions. And of course, you guys know us. Please do not hesitate to reach out. Do not hesitate to reach out to us, and we're of course very, very happy to engage. In anything that you think might be relevant. These are my coordinates. If you want to write to me, you can write to me at name.surname@praxisga.com. Yeah. So one last question around analyzing IT services. IT services, probably a separate masterclass we'll do, but IT services is a lot more about pipeline, bid management, account management. Also sort of there's a deeper cost play. So all the automation, digital engineering, right? Being able to sort of lower the cost of the process or cost of the workflow that you are in. I think IT services works with a very different mindset. And it's still a bulk sale and aimed at driving labor productivity in some form or fashion. While SaaS businesses do not directly work on labor productivity, even though they do reduce labor intensity, in workflows that they become a part of. Anyway, I think we should probably, Praveen, happy to sort of happy to do a separate discussion on IT services. We looked at several IT services and diligence many of those. Very, very different drivers actually. Cost, automation, analytics, bid, pipeline, all of that stuff becomes very important. And then, a lot of cost factors become very, very important. How you manage costs overall. SaaS is not as much cost.